Hello and welcome to our latest webinar on Brexit, the budget and beating Covid-19. I'm Lee McDarby, CEO of International Payments in the UK here at Moneycorp. A few housekeeping points before we start. We'll be recording this webinar and a copy will be sent out to you all for ease. We'll have plenty of time at the end for questions, so please do add them to the question panel on the screen. If we run out of time, we'll be sure to answer them all individually by email after. Today, I'm joined by a special guest. She's an economist and a business consultant, as well as being the Chief Economic Advisor and a board member for the Centre for Economics and Business Research, also known as the CEBR. Vicky Pryce will take us through the effects of the last year in lockdown, various forms of lockdown. Vicky has been a friend of Moneycorp for quite a while now, and it's great to be working with her again. And I can generally say that when I listen to Vicky's webinars, I leave knowing a lot more than when the webinar starts. This is sure to be a very informative session. We'll be covering, amongst other things, how the budget may affect businesses, the strategy to end COVID-19's grasp on the economy, and the impact of Brexit on business. Once again, please don't forget to add your questions to the question panel. And with that, I'd like to hand over to Vicky.
Thank you very much. So we are indeed, as Lee was saying, a year on from the lockdown. I think the anniversary was yesterday, and a lot has happened since. The interesting thing is that we seem to be coming out of the sort of deep recession that loads of countries experienced, and certainly until the recent concerns about the vaccine rollout, particularly in Europe, and worries about whether the recovery that we were hoping we're going to see is going to materialize as soon as we'd like it to, the mood had been improving quite considerably. So let's see where we were just a month ago. If you look at the global purchasing managers index, it had recovered very significantly in the last few months. In fact, in a number of countries like China, for example, we've had positive growth in the economy really since early spring. In some other countries, it took a little bit longer. Places like the US, of course, it recovered too pretty soon after the initial drop, despite the number of COVID cases that we have seen and the problems that the US has had there with COVID. Nevertheless, what we've got is that global PMI in February continued to grow and was the highest since last October. The reason why it is important to mention that is because there had, of course, been the odd extra lockdowns in the autumn. So the last year has been characterized really with many lockdowns that have happened in different countries at different pace and at different times. And that, of course, has added considerably to uncertainty. But overall, nevertheless, we've had quite a consistent improvement in the world economy, even though some of that improvement was happening in different countries at different times, and that, of course, has been interesting for investors to follow and fully take advantage of. So let's look at some of the countries. In the US, for example, what we've seen is that the quarterly conference board CEO confidence survey showed optimism being at a 17-year high. That, of course, has reflected quite considerably the extra package that has been announced by new President Biden, the 1.9 trillion, which is, of course, expected to be quite helpful to quite a lot of cyclical stocks in particular. And, of course, confidence has improved as a result. What I'm showing here is the Business US Roundtable Confidence Indicator, which also picked up. So that's another sign of things improving and something to look forward to for the future. And on the back of that, the US itself has upped its forecast. The Federal Reserve just last week upped its forecast for growth for the US in 2021 to 6.5%. What we see here is that the OECD had already anticipated that more or less, and the forecast that they have produced shows something very similar. For 2021 for the US, 6.5 growth and followed by 4% in 2022. That, according to the OECD, is increasing the expectation for this year by a good 1 percentage point higher than they had expected back in December. So that's a big change. The expectation, of course, is that the US will act as a sort of locomotive for growth, importing quite a lot more commodities, and goods more generally, and that will benefit the world all across. So positive growth for 2021, really starting probably for the rest of the world in the middle of this year. The interesting thing to watch, of course, is that China was one of the only countries, so Turkey showed a bit of growth too, but China was the only big country to show positive growth in 2020. And that is likely to be followed by more growth and faster growth in 2021. Now, of course, we have to watch that a little bit because even in China, because of what's been going on in Europe in terms of demand for its products, we've seen industrial production and general PMI slow down in January and in February. But overall, the expectation is that that will recover pretty quickly. What this has done, of course, is has intensified worries about inflation. What we're seeing is that commodity prices have risen quite significantly. Yes, of course, we've also seen oil prices rise to pre-pandemic levels. However, of course, very recently, because of the concerns about lockdown, they've been coming down again. And there had, of course, been cutbacks in production by OPEC, which have continued. Interestingly enough, although they did raise the price quite considerably for a while, this has been coming down in recent days. Remember, of course, a year ago, oil prices were negative for a while. This is copper prices going up very significantly because, of course, copper is also needed in the move to net zero because, of course, it's so important for electric vehicles and so on, and also nickel prices going up. Natural gas prices have doubled. What this has done is it has encouraged people to worry a little bit about inflation. What we've had, of course, from the Federal Reserve is as expectation, and at least some sort of pledge that they wouldn't raise interest rates in the near future. In fact, not for another 2 years, even if inflation exceeds targets. But nevertheless, the markets have reacted, and the US yield curve, of course, started going up for longer term bonds. And that, of course, reflects very much that type of expectation of price rises. That, of course, also means that funding those enormous packages of fiscal measures that a number of countries have introduced, including, of course, the US, may well become more expensive in the future. What about the rest of the world? I mentioned the problems about lockdown in Europe, and Germany, of course, has just announced another period of lockdowns coming up, which are not going to be lifted until early April, and let's see what happens then. This was nevertheless the German IFO Business Climate Index, which had been improving. Didn't do particularly well very early on because there was some concern about slowdown in the economy. It did improve a little bit later because of the vaccine news, but now, of course, with the problems with the rollout of vaccines in Germany and elsewhere, and also, of course, the increase in cases, we might see that go the other way. And in fact, economists have been busily reforecasting growth for Germany in particular, which of course will be so important for the rest of Europe, downwards. So we may not see more than 4% growth in Germany this year. And frankly, who knows what will happen in the next few months that might in fact bring that even further down. Well, the UK had escaped a double dip. We were very lucky in a way, because the last quarter, instead of seeing a decline, actually just about rose a little bit in GDP. But what, of course, we've seen is that the beginning of the year hasn't been particularly good. January data suggests a 3% fall nearly in the economy. And I think it's worth bearing in mind that partly because of Brexit, but partly because of the new lockdowns, of course, that we have introduced here as well, which are meant to be coming to an end, hopefully in a week, really, in terms of the first easing, and then hopefully it will keep to the schedule that the Prime Minister has announced, and we'll have freedom supposedly by the middle of June. nevertheless, the forecast had been that this quarter will see a decline of possibly 3.8% if we believe what the OBR said in the budget forecast that followed the Chancellor's speech. And that, of course, would be partly the lockdown, but also partly the Brexit disruptions that we have seen at the border, but more about that in a minute. If we look at what actually happened in January, looking at sectors, the really interesting and surprising thing was that until recently, the growth that we had seen in the UK had been mainly in the manufacturing sector, but also the construction sector. Remember, in the first lockdown, since it is a year since, manufacturing and construction basically stopped. When things opened up and then we went to a new lockdown, manufacturing carried on operating, as did construction. So since the summer, really, construction and manufacturing have been on an upward positive trend. And the first real fall that we've seen in manufacturing happened in January. Now, a lot of it may well be linked to Brexit. Huge amount of stockpiling early on, a lot of production in order to export it to Europe happened. And that is, of course, another reason why people are suggesting that the fall we've seen in trade with the EU in the first month of 2021, which may have carried on a little bit in the second, may well have been because all the business was done earlier. And that, of course, was also reflected in quite high manufacturing production at the time. So let's see how that develops, but it is certainly against the trend that we had seen before. So that was January. There was some improvement in February. If you look at the composite PMI, it's moved to stable. 50 and above is an expansion. We're back to just 50. And the question is what would have happened in March. I mean, what we've seen is that certainly construction activity seems to have continued. We've had a real boom in house building, particularly because of the stamp duty reduction, which has encouraged also house prices to rise. But there is also quite a lot of indication. We've seen the unemployment data, which came out today, came out actually yesterday, which is indicating that there is an upward movement, that February saw an increase in employment, in fact, or at least the number of people on payroll. And we've seen also that recruitment activity is increasing, also in areas which have been shut for quite some time, including pubs and hospitality and recreation and so on. So a bit of hope there that that is going to work. Having said all that, the interesting thing for me was that the OBR, which produced its forecast in March, very early March, actually thought that GDP in 2021 was going to be less strong, the growth that we're going to see, the bounce back we're going to see, than they thought back in November. So they expected a 4% growth, but slightly more optimistic on the unemployment rate, that the peak wouldn't be as high as they expected then, at 7.5%, but it would be at 6.5%. Now, given the data we have now, which is that unemployment is at around 5%, that perhaps is correct, but we just don't know what is likely to happen at the end of the furlough scheme, which, as we know, has been extended. The expectation now, the estimates are that maybe there are 4 million people, maybe even 4.5 million people, it's just not terribly clear, who are on furlough right now. What happens at the end of the furlough scheme, of course, is unclear. The interesting thing also is that because of the extension of various schemes, which have been very welcomed by business, borrowing is likely to remain very high in the next few years. There's an extra 65 billion, which is being put into the economy as a stimulus for next year, because of all the extensions of the various schemes that were announced. What it means is that after borrowing 355 billion this financial year, which finishes, of course, at the end of the month, early April, we're going to be borrowing another 250 billion next year. And even by the end of the forecasting period, which is 2025-26 financial year, we'll still be borrowing some 74 billion, slightly less than was forecast in November, which is the yellow bar, but still very substantial. What this means is that all this talk about paying back debt simply isn't happening. We're just going to be borrowing more and more. And one of the reasons for that is that growth in the economy isn't going to be that great. What you see here, if you look just at the first line, is the forecast by the OBR. Yes, a bounce back in 2022, fueled possibly by all these savings that we've all been making, not all, by the way, because of course it's been a very unequal pandemic. A lot of people have no savings whatsoever and have been in serious financial difficulty. But on average, the expectation is that people have been saving quite a lot by not being able to spend because things have been closed. So there's a lot of pent-up demand. There's something like anything between 100 to 250 billion, which has been saved by households, or will be by the middle of the summer or by June, when we're supposed to have all the restrictions lifted. There is also an expectation that there is some 100 billion of savings by, or cash being held by businesses ready to invest. And do remember that the budget also had this super deduction that can be done by businesses immediately before the corporation tax increase that has also been announced. So there is an expectation, if you look slightly further down this table, against business investment, the business investment will recover very significantly in 2022. The problem is that a lot of it will be just displaced from later years. And if you move to 2023, 2024, 2025, we're really going to have very minor growth of 1.7, 1.6%, going back basically to where we were. No real shift in productivity, no real improvement in the underlying behavior of the economy, and that is a worry. But what that means, of course, is that if it isn't growth that's going to improve the debt to GDP ratio, I'm afraid we're going to have to live with a GDP ratio, debt to GDP ratio, which is going to be high for some time to come, and in fact probably stay above 100% for some time. If you look at the blue line, that's the March forecast now, that indeed we're not going to get back during the period of this parliament, certainly, and even beyond, to anything below 100% debt to GDP ratio, because growth simply isn't going to be there to achieve that. We're going to continue, therefore, to need to borrow a lot. Having said that, the debt servicing costs are low. They're at record low levels at present. There is a bit of a worry, of course, that this might change. But if you look at it as a debt interest percentage of revenues, it is certainly affordable. Here too, though, I mentioned the US earlier. What we've seen is that the yield curve has moved up because of expectations of inflation. Now, interesting to see what's happening right now in the markets, given that the inflation figures that came out today, this morning, suggest that, in fact, instead of inflation going up, it's being reduced. So the latest data is just 4% instead of the 7.4%, instead of the 0.7% year on year. Inflation that we had the previous month. So in fact, some of these worries perhaps are misplaced, but of course it could be due to all sorts of reasons, including discounting by stores, clothing in particular. But nevertheless, the trend isn't going the way that the Bank of England had worried was going to be the case. So let's just look at the budget quickly. I already mentioned the corporation tax increase is going up to 25%. In 2023, we have the freezing of income tax and other income tax thresholds and other thresholds. That, of course, is raising a certain amount of extra money. Altogether, perhaps 25 billion by 2025-26. I mean, not huge, but quite significant. But there are also spending cuts that have already been announced and were reinforced in the budget of an extra 25 billion. And then, I mean, that, of course, brings it all up to about 50 billion. But the super deduction that I mentioned is likely to cost 25 billion. But you can see here that where the real changes can happen or should happen in the future, if you really want to reduce your debt to GDP ratio and certainly your deficit to GDP ratio, then you need to tackle other areas such as income tax, national insurance contributions, and so on. Were there likely to be any changes, even in areas like capital gains tax and pension contributions and so on? There were some, of course, in the budget, but in reality, it doesn't look like much will happen. We've had the tax note that came out yesterday, which is a tax day, which actually didn't cover any of those areas. So some parts of the economy will breathe a sigh of relief that perhaps capital gains taxes are not changing, but there may well be some changes at some point in national insurance contributions for the self-employed, but for the moment, all these things are under review, and more importantly, the business rates regime stays as it is, but there will be more consultation taking place, and there will be more announcements in the spending review in the autumn. But just on the basis of what I've shown you, the tax as a percentage of GDP is going up very significantly and really highest than it has been in decades. There is, of course, a political calculation there. It is just possible if the economy does better than what I've shown you, maybe some of those tax increases will not happen or will not need to happen. And maybe the election time period might change too, but I leave that politicians or people who know the political cycle a bit better to comment on. What has happened, of course, in the meantime, partly because of the budget announcements and also the extension to help to businesses that has taken place and to individuals, is the business confidence has improved, the vaccine rollout in particular. And we've seen not just the ICAEW one, which is very positive, but also the CPI Industrial Trends Survey, which just came out the other day, also very positive. And we've seen consumer confidence improve quite significantly, which is good news. I mentioned the amount of money that can be spent if people do feel more confident. We have to bear in mind, of course, that at the same time there has been this inequality that I alluded to. Again, some survey work by the FCA suggested that some 3.5 million extra people have joined the ranks of those who are financially challenged, seriously challenged and in great difficulty. And that's one of the problems that will have to be addressed as we recover. Now, of course, a number of sectors have done well during the pandemic. You recognize a number of those. It's interesting, of course, that on the entertainment front, where everyone was worried about it, we've had huge successes in the areas of streaming and lots of programs coming through different means than just going to the cinema, for example, or to the theatre. But loads of other services and other areas have done well. I mentioned, of course, manufacturing, but then pharmaceutical sector has done well. We've seen life sciences, of course, do well. Interestingly, the used car market, but the data today suggested that actually car prices have come down, which is interesting in the second-hand market. One of the reasons for the low inflation. Housing market has done well, as I said, and house builders have done well. Investment banks, there's a big issue, of course, in the news today about Goldman Sachs and others making people work 90 hours a week because, of course, it has been very busy for them. The worst performers are all the other areas of leisure, entertainment, and accommodation, hotels, tourism, airlines, of course, with the problems with countries in Europe, of course, now having more COVID cases, the chances of travel abroad seem to be reduced. Face-to-face retail, of course, has suffered huge closures across the economy. So we've seen that over the last year since the pandemic hit. But of course, a number of the sectors that we're seeing do well and do badly had already had those trends shown in those sectors before. And what the pandemic seems to have done is accelerated those, including the closure of stores, retail stores. There are worries about the future, exactly how retail will shape up and the high streets. There's been some extra money put into towns and cities by the government. But also the question is, all this lending that banks have made, some of it's guaranteed, but quite a lot that they had been involved in before, not will there be another banking crisis to follow. And in terms of how things have moved and the differences, I just love that slide, and I thought I'd put it in here just to show that people have rethought their holidays and instead of going to hotels and so on, which they don't expect to be doing very much, they've been buying camping equipment. So that has boomed, as you can see here. Well, let me just move just to the final bit, which is Brexit. We had seen a strengthening of sterling since the end of the transition period, a little bit more certainty. But that seems to be coming to an end now. A weakness of sterling has returned. Of course, a lot of it may have to do more with what's going on. The dollar hasn't changed hugely against the euro, though, of course, they will be having difficulties in the future. And strong sterling is good generally for inflation, a weaker one not, but also a weaker sterling is good for exports, and we absolutely need that, especially if productivity isn't improving as we would like it to. And then finally, the serious concerns about growth, trade, and so on. What we're finding, of course, is that exports to the EU have suffered quite significantly at the very beginning of 2021. You've also seen food and drink exports, when you dig a little bit deeper into the data, falling by 75% in January. That's a big drop. Of course, there are now reports that things have improved a little bit, but as you know, the UK has decided also on the import side not to impose any serious checks until the summer. That's been now extended. There's concerns about GB to Northern Ireland, where the UK unilaterally also stopped doing any checks. And of course, there was a legal challenge by the EU. The situation hasn't been particularly good, and the lack of trust has also affected, in a way, discussions on other areas where non-tariff barriers are really important, such as the financial sector, where we're expecting a memorandum of understanding by the end of this month, but no real conclusion on the equivalence issue, so that businesses can trade a bit more freely and know what the outcome is going to be. With the final result, of course, is that business is telling us very clearly, and this is a survey by the British Chambers of Commerce, that Brexit is making exporting harder, and quite a lot of firms are deciding not to bother. And the interesting thing, of course, again, a little bit like in the various sectors that I showed you before, is that it tends to be the smaller firms that are worse affected, and the big firms that are able to cope with it better. So a bit of a negative worrying, if you like, trend here on the Brexit side, and of course, fingers crossed that some better arrangement could be agreed in the next few months. But for the moment, as the OBR has said, Brexit is an issue, and while COVID is likely in the long term to take something like 3% off GDP permanently, Brexit might take 4% off GDP permanently. Add 3 and 4, you get 7%. Not too good news, really, looking ahead. Thank you very much. So I'll pass back to Lee to take us through the rest of the session.
Thank you very much, Vicky. Apologies if there are any IT gremlins at any point during that. If it sounded a little bit robotic, that's just my presentation style. It's definitely not the case with Vicky. So that was very informative, and hopefully everybody got the gist of the slides. One of the upsides of lockdown is that we can put webinars on like this, which have been very well attended. So the attendance today has been fantastic. It gives us a greater reach. So thank you all for attending today. And obviously in the future, we're really looking forward to seeing everybody face to face back in some sort of normalized world, hopefully by June, but let's see what happens in real life. So thank you, Vicky, for a very insightful presentation. We're going to move on to some questions now. So please remember to put your questions in the question panel at the side of the screen, and I will get the ball rolling with a few here. So Vicky, on the 3rd of March, we saw Chancellor Rishi Sunak deliver the 2021 budget speech. What key announcements, in your view, will affect businesses going forward?
Oh, the most important thing for me was the extension of the various schemes, which of course had been pre-announced. I mean, that was an interesting budget in the sense that we knew more or less what was going to happen beforehand, whereas in the past, chancellors had to resign if anything was leaked, just before the budget. Now, of course, you get all these warnings and all the announcements done, which is good news in many ways, because the more information you have in terms of how you can prepare for whatever is coming ahead, the better. And what had happened throughout the whole pandemic period is that quite a lot of schemes which were supposed to help business, such as business rates, holidays, and changes in when you have to pay your tax and so on, and of course the furlough scheme, which has been such an important part, that those announcements would be left to the last minute, and that was not particularly good for businesses, and not particularly good for planning ahead, not particularly good for deciding whether to keep employees or not. So that's the first one, the extension for a few more months, absolutely significant. And also, of course, the capital allowances that have been introduced before, of course, the corporation rate goes up. So one has to put it against a lower corporation tax rate. But nevertheless, that's all good news. What is also interesting, looking ahead, particularly if you are a small business, is that the increase in the corporation tax to 25%, which is supposed to take place in 2023, reestablishes in that increase the difference between big and small firms. And the small profits corporation tax rate is reintroduced. Remember, until 2015, there was a gap between the two, small and large, and that was at times more than 10% if you go back through history. That was abolished in 2015 when the corporation tax rate went down to 19%, when it started actually going down quite significantly from then. And then by the time, of course, we were looking at sort of 19% corporation tax rate, it was exactly the same as the small firms one. So it was abolished basically a few years ago. Now it's been reintroduced, and that should be quite positive, I think, for SMEs. But obviously, one has to deal with higher corporation tax rate in the future. And the question is, of course, which particular sectors it might hit worse, but there is no doubt that profits will be taxed more. What the rationale, of course, is that at least one taxes profits. Quite a lot of firms have been making huge losses, of course, for quite some time, and it isn't going to impact them until they start being profitable again.
Thank you. So yeah, please keep adding some questions into the question box at the side. I've got one here which is on vaccine and will possibly require a little bit of crystal ball from you as well, Vicky. So obviously yesterday was the year anniversary since the first lockdown, but we do have a roadmap in place, as you mentioned, to get back to some sort of normality. Hopefully June is that date. We will see. But at the same time, we're also seeing vaccination supply chain issues. So what's your view on the current strategy, and do you think it's going to be successful in controlling the pandemic in the UK?
I think the rollout has been indeed very successful so far. Yes, indeed, there are some concerns about supply during April. What we know is that the EU is meeting today, or at least it's going to be announcing today a new regime for allowing exports of vaccines from the EU to other countries, which will also look apparently at how well vaccination regimes have gone elsewhere. So if they think that they don't need any extra vaccines or too many extra vaccines, they might be blocking those. So of course, the fact that we've been so successful may be against us. On the other hand, there's huge amount of trade that goes on between various countries for the various bits that go into the vaccine. So we import an awful lot and we export quite a lot, depending on what is needed to put this whole vaccine together. So there is a lot of trade that happens anyway. So we each need each other. So there is hope that perhaps it isn't going to hit the UK particularly. There are also problems from India, as we know. So there could be a bit of a supply issue. Nevertheless, there are other manufacturers of vaccines who are thinking that they may be able to provide quite a lot more from other vaccines, certainly by the autumn. The expectation, of course, had been that everyone will be vaccinated by the end of the summer. I think that is still quite likely. Already something like, what I think is 55% of the adult population has been vaccinated in the UK. I think we can be reasonably optimistic about this, and that it will make a difference in terms of also stopping the rate of hospitalizations and so on. That's already proven to be the case. So yes, I'm quite hopeful about that, even though there might be some short-term issues that might slow down the speed of vaccinations temporarily, but I'm pretty certain they will be sorted out in the following months that will come. So yes, I am an optimist on that. What worries me in terms of looking at various sectors and how they do is what happens in other countries where it's been very, very slow. So in Germany, only 8% of the population has been vaccinated. If that means that A, we can't travel there, and B, they can't come over here, that's going to affect tourism quite significantly. And of course, lots of sectors that depend on more people being around using, hospitality venues and so on. So it will have a dampening effect on the economy, even if everyone buys camper vans and and goes and cancel across the UK instead.
I do like the camping slide. That conversation has come up in this household as well, and I'm actively trying to avoid it, as great as it sounds. But let's, as you say, let's see what happens in June. So we've got a question here on the euro, which again will involve a little bit of crystal ball, but at the same time we can look at what's happened on your slide since the end of the transition period and after Brexit. Sterling's definitely done well over that period. Although in the last month we've probably seen sterling euro come off a little bit, and right now we're hanging out around that 115, 116 level. What is your view on sterling euro foreign exchange rates for 2021?
Okay, well, obviously I'm not going to get down to giving you a figure, because I'm not in the business of forecasting into that detail looking ahead. But what's happening, of course, is that not only is the European economy slowing down, but also the European Central Bank has made it very clear that it's going to be intervening more heavily to support the economy, and of course in the process it will be bringing yields down. So there is still a possibility of even lower negative rates in Europe. So the ECB has already in any case announced that, well, at least it didn't announce the exact figure it's going to be using, but it's already been upping the amount that it buys every week in the secondary market, the amount of the gilts it buys, or whatever they're called, of course, the European bonds that it's in the process of buying every week, to something like 21 billion euros a week. I think it had gone down to about 14, which was quite low. So it made it very, very clear that it's going to be intervening a lot more heavily. And it does intend to spend something like 1.8 trillion in buying operations, both in terms of government bonds, but also in terms of corporate bonds. So my expectation, therefore, is that interest rates and yields in Europe will be, so longer term interest rates, in other words, will be quite low and lower than had been originally anticipated, given the slowdown that's taking place right now. On that basis, particularly given that the Bank of England seems to have kicked in the long grass the possibility of negative interest rates here, I would suspect that sterling isn't really going to lose much, if anything, against the euro. Might actually do reasonably well. I hope that helps, but I'm not going to forecast a specific rate.
That's insightful, and forecasts can be provided by relationship managers. So if you do wish to see the Bloomberg composite forecast, which is what many banks' forecasts brought together into a single chart, then please reach out to your relationship manager, and they will be able to provide you with that material from our providers and from Bloomberg. I've got a question here which we'll take any question at all. So this is a good question, but I just want to make sure I'm interpreting correctly. So the question is, any news on taking a commission transferring monies to bank accounts in Spain from the UK? So I think this isn't one for you, Vicky, unless you would like to chip in on what's happened in the European Union banking network since Brexit. But what we've seen is, so just to sort of maybe rephrase that question, what we're seeing is European banks are now taking additional charges, which are certainly out of Moneycorp's control when you're sending money from a British bank account. We've tackled that head on at Moneycorp, and what we've actually done is we've opened a bank account in Frankfurt, which we are going live on this week for private customers, and I believe next week for corporate customers, which we've tested thoroughly and will help to alleviate some of the charges that European banks are taking on payments. It's called clipping charges, and it's kind of out of our control, except for getting these additional bank accounts specifically set up to deal with the situation. So that's what we've done. Again, as per the previous question, speak to a relationship manager on that point, but we should have some very good news on that, and hopefully people haven't been too severely impacted. But we've reacted really quickly, and it wasn't something that was foreseen, and it just feels slightly advantageous by the European banks in terms of some of the fees that they've attached. So hopefully that clears that point up. But again, please speak to your relationship manager.
Can I add as well
Vicky?
that, of course, absolutely. I mean, since Brexit, a lot of that is happening, and as we know, people are finding that they have no longer the ability to keep their bank accounts going by various UK banks, and also by local banks as well. So there's been a bit of an issue. What you're finding is that the credit card companies are now charging also more for transfers between the UK and the EU, and you've probably seen that too. So if you're paying with your card anywhere in Europe, then that can become considerably more expensive. So as we know, on the basic retail and deposit side, retail banking deposit side and borrowing side, once you've lost the mutual recognition arrangements that we had as being part of the EU and with a third country, there have to be country by country agreements, and every country has a different view of what it wants to allow and what it doesn't want to allow to happen, and also how it controls what is charged and isn't charged by the various banks. So that is going to be a problem, I'm guessing, and you're getting around it, I presume, through different ways.
Yeah, and we're fortunate. The specialist payment space is a highly regulated arena, and when we knew Brexit was coming down the line after EU referendum, we very quickly embarked on getting our European license, and we've got a fantastic relationship with the CBI in Ireland. It was a long process, but we were the first payments provider to get that European license through our entity called MTL. Which future-proofs our business and then allows us to quickly react in situations like this. But clearly, from a regulatory perspective, we have to be very careful about what we do in the UK against what we do in Europe. So, as I say, in our space, it's always just always check about the regulatory setup of businesses. And as I say, ours is of a very, very high standard, and we do have that license directly into Europe, and we don't have to then partner with someone else to keep our European business going, which puts us in a fantastic position. Just a couple more questions that I've got here. So along with the pandemic, British businesses have had to deal with the added challenges of Brexit, such as new procedures and tariffs. Which sectors, in your opinion, Vicky, are bearing the brunt of Brexit at the moment?
Oh, if you look down the list of those that have suffered from all these non-tariff barriers, I mean, we have all the areas, of course, around exporting goods, which are a problem. But if you look at the road haulage industry, it's one that is already affected, will be affected more significantly, and also the airline sector, for example, and general logistics. Now, banking, we still have to wait and see what happens there too. And we've already seen quite a lot of movement of funds out of the UK, and also trading. Of course, I suffered quite a lot of trade moving to Amsterdam, for example, because you can't no longer trade in our stock exchange EU denominator listed company shares. The problem, of course, with particularly road haulage and the airline sector is that the rules of cabotage have just gone. So a road haulage company will now be able to go to Europe and do one trip within Europe and then has to come back. Before, it could do 3. So it actually made it considerably more profitable to do any sort of transfer of goods and therefore come back also full and earn quite a lot while out there. Of course, EU companies could do the same. They could come here and do sort of 3 trips in addition to the ones, of course, that they did originally when they came in. And that's within the country. That, of course, means that there's going to be less competition in the UK. But overall, it makes the whole thing, in terms of exporting to Europe and importing from Europe a lot less profitable for whole large firms, and that's a serious issue. The result, of course, had been that quite a lot of firms found that their lorries were going back empty to Europe, certainly during January. So that's one. So you're losing that particular right. On airlines, it's the same. Before you could do 3 trips internally in Europe. Now you can only really do 1 and then get back. And that, of course, again, affects quite significantly the type of operations you have and the profits you make. And the result, of course, is that loads of firms are registering elsewhere to be able to carry on doing so. So this is just an example of sectors that are particularly affected.
Thanks, Vicky. Unfortunately, we're running short on time now, so it is now time to wrap it up. If you would like to get in touch to discuss your current risk strategy or how you do your payments, or how we can assist in any way when it comes to helping out you or your business, then please either contact your relationship manager or email events@moneycorp.com. Alternatively, you can visit moneycorp.com for more information on our products. And if anybody has any further questions, please do feel to send them through to Vicky and I, and we will endeavour to get an answer over to you as soon as we can. So thanks for joining us all, and thank you, Vicky, once again for joining us this morning.
Thank you.